Hello and thank you for joining us for today's webinar. This session is being delivered as part of our Tourism Enterprise Development Programme. We've been working closely with industry over the last number of months to shape and roll out this programme and respond as best we all can to the unprecedented events of 2020 and the ongoing impact of COVID-19 on the industry. You can access a range of COVID-19 support materials as well as signing up for webinars and expert advice on tourismni.com and covid19.tourismni.com. We've initially prioritised financial support, including financial planning, setting financial targets, cost-based analysis and pricing, as these are areas that continue to be raised with us by the industry. We would encourage you to continue to feed in on priority areas. If you could complete the feedback form following today's webinar, we can continue to tailor the programme to your needs, or indeed at any time, just feedback through tourismni.com or covid19.tourismni.com. I hope you all found today's session useful and informative. Thank you.
Good morning, everyone. I am Michael Williamson. Thank you very much for joining us for today's webinar on the Capacity and Commercial Impact Calculator for restaurants, cafes and bars. Before we have a look at the calculator, I suppose I'd just like to quickly run through I suppose the agenda for today, for want of a better term. We all know and we all accept that it's been a hugely difficult time for tourism and hospitality, and indeed, you know, I think when we first sort of entered the current phase that we're in way back in March, I don't think any of us would ever have foreseen that we would be in a similar situation at the back end of the year. But thankfully there is some hope on the horizon, obviously with announcements recently about a number of vaccines coming forward. So hopefully 2021 can't possibly be as bad as 2020 and there will be better days ahead. Really, you know, the current situation as it stands, and not knowing when we can trade until the last minute and so on and so forth makes planning extremely difficult, and indeed decision making even more so. And you know, it's one of those things that we have to just try and battle our way through as best we can and use some tools that we have that hopefully when we get open again we can actually make a very positive contribution to each of our individual businesses. In smaller businesses as well, we all recognize that it's even more difficult for those smaller businesses where perhaps you know, there is a resource constraint in terms of financial information that may be available, and that just adds to your uncertainty, and that's fully recognized. And in many ways the calculators that have been developed for the industry in conjunction with both Fáilte Ireland and Tourism Northern Ireland are really aimed at smaller operators where that resource doesn't necessarily exist in-house to any great extent. Today's webinar, I'm going to cover a number of points, really a bit of background to the calculators, because I think it's important to understand what the motivations were, and they were driven by industry in terms of the sort of things that they would like to see. It's also important to understand costs in your business. I know that seems fairly obvious, but you know, I certainly have some issues with some of the KPIs that the industry traditionally uses, because you know, whilst they are useful, I think in the current climate we can do better, and we'll have a look at that. And how they might impact in terms of how you assess your business, and indeed how you assess it going forward, or any other services or product lines or whatever that you may be planning to introduce. I think this will be a useful tool for you. Where I will then give you a demonstration of the actual calculator. I've already populated it with information, but whilst it may look daunting in terms of pages with lots of numbers on them, the reality is that in fact you don't need to put that much information into it, but we'll get on to that later on. And then, you know, towards the back end, and I think probably it's worthwhile giving you some tips and pointers about any conversations that you may be having with your own accountant, whether that's in-house or someone who provides your annual accounts for your accounts preparation, because I think there are some practical things there that you should be looking at. So moving forward then, so what is the calculator? Well, really, it's a suite of tools available to you, ultimately to help you make better informed business decisions. They are Excel spreadsheets, so essentially they're a whole series of calculators. on the Tourism NI COVID-19 Support Centre, there is already a video of how to use it, and there's already a user guide available on how to use it as well. But today will be a much more practical demonstration of it actually in use. And whilst it was developed as a direct response to COVID-19, as I said, for smaller businesses, the truth is that it can actually be used going forward if you so wish. As we sort of move out of a transition from lockdown into trading, albeit that may still be constrained by social distancing rules, and then hopefully in the not too distant future back into normal trading patterns. The calculator itself, I suppose, where did it all start? Well, it was really conversations between Fáilte and Tourism Northern Ireland in response to the industry saying, look, we're not really sure where we stand as organisations. We're concerned about our financial position. We maybe just don't know as much about, or we're maybe not as well informed about how we're performing as we readily could be, and of course, the capacity reduction in terms of social distancing really threw a spanner in the works, and we heard it, from all the representative bodies as well, as that businesses cannot trade profitably with the restrictions in place. And in many cases, that's probably right. But for some of the operators out there, maybe some of you viewing this morning, in fact, you may have had additional space where you could maybe capture back some of that lost capacity, or perhaps you could offer other services. For example, takeaway has been a popular one, where again, you could possibly claw back some of the revenue that you were losing simply because you had a capacity constraint within your own restaurant, bar, or cafe. So it was really, the models were designed around, look, if we're going to be in this position, either with our capacity constraints, and whether we can mitigate that in some way or other, does it actually make sense for us to open, or what do we need to be looking at? So that was really the kernel of why the calculators were developed. And so it will look at that for you. It will hopefully identify where you might or you risk trading at a loss. If you're planning on offering some new services, better to find out beforehand that it might not make money rather than find out a month later when you've spent money on it and then realize, look, this may not work, or indeed give you the confidence to make the decision to go ahead if it looks as though it is going to work commercially. So the model will give you that opportunity as well. And because it produces quite a few key performance indicators, it should help you identify areas within your operations where you may be able to improve your profitability simply by reducing costs or better cost control. Now, it's not designed to be anything other than a simple tool for you, and it looks at performance in blocks of 4 weeks on a daily basis. So it will give you that information, that output information, on a day-to-day basis for up to 4 weeks at a time. The calculator as well has been designed around this idea that in some cases operations may have other space within their premises, for example, maybe a private dining room that could be utilised to claw back some of the lost capacity. So, and if you're in the fortunate position where you can do that, or perhaps you have an outside dining area, maybe not terribly useful at this time of the year, but nonetheless, if it's something you can use, and inevitably, there's probably an additional cost in terms of providing your services in those areas. And again, the model can take account of these to let you see whether or not it makes sense to open some of these other areas if you have them available to you. And indeed, let you see whether or not you're going to actually make a profit out of doing that. And as I said at the outset, it will produce a number of key performance indicators for your business, some of which will be familiar to you, some of others that you might actually find useful in terms of planning ahead. So how does it work? Well, when we get to it later on in this presentation, as I say, it might look initially a bit daunting, and in this particular calculator, there are actually 2 calculators within it. There's a highly detailed one which will look at service, break the service day down into three segments, being a sort of a breakfast and morning service, if you offer that. a lunch and afternoon service, and a dinner and evening service. And then there's what I refer to as a standard calculator, which is the one I'm going to concentrate on today, which requires less information, less input from you, but will analyze it as much as it possibly can do. It'll not break your performance down into 3 segments because it won't ask for that information, but it will actually give you quite a lot of detail in terms of how you're performing in the individual areas within your business if you have more than one room in which to serve, for example. And it does ask for the least possible amount of information from you. So be reassured that even though it may look daunting, the reality is once you load data into it, and we only require that information once, it carries it forward into subsequent weeks. So your data entry after week 1 becomes literally very, very minor, and we'll see that as we go through. The whole model itself is highly automated with a lot of it's driven by formulas, and they're protected, so they can't be accidentally corrupted. So the formulas are there and they're preserved, and it will, as I say, provide quite a lot of detail in terms of key performance indicators, an idea of whether you're likely to make money or not, and it'll provide quite a bit of underlying detail. Before looking at the calculator, however, I want to have a look at the importance of understanding the costs in your business. And importantly, perhaps looking at them in a slightly different way that may help you in making decisions if you're thinking of offering new services, or indeed even assessing some of the current services that you offer. So I'll start by just a bit of background, and you'll know most, if not all, of this. But it's worth remembering just the nature of cost, because ultimately the model is really built on these basic principles as well. It could be argued really in business that not many costs are truly fixed, and that they tend to be what's referred to more in accountancy terms as being stepped. And what we mean by that is really as your sales volume increases, there comes a point where probably what are traditionally your fixed costs have to move upwards as your volume increases. So maybe a good example of that might be your permanent staff costs, for example. There comes a point where they're working at maximum capacity, and therefore to bring more customers into the business, you actually need to add in to your fixed payroll. Or maybe, in better times you've been hugely successful and you need to expand your business into more space. Therefore, perhaps you need to rent more space, for example. So there's a step in cost at some point, and that's typical in nearly every industry. It's not something that's not unique to hospitality. The other then side of costs, as we generally refer to them as fixed and variable, your variable costs then rise in relation to the volume of sales that you have. Some of them will rise in proportion to the value of sales that you have. So, for example, maybe credit card commissions, for instance. But by and large, they increase as your sales volume increases, or vice versa. Things like cost of sales for whatever. But those changes may not necessarily be linear, simply because the busier you are, you may have more efficiencies in terms of producing dishes. You may have better buying power, or indeed your sales mix will have an influence in terms of the rate at which your costs rise in relation to your sales volume. But the underlying principle is as volume rises, your variable costs increase in tandem. Therefore, the total costs in your business then are an amalgam of both your fixed costs and your variable costs. And in this little graph, you can see there's a little step halfway along on the red line, and that's back to this principle that in fixed costs there comes a point where they're not fixed forever. Once you hit a certain volume, they're going to shift upwards or downwards, depending on whether your volume is moving upwards or downwards. But perhaps most important of all, in terms of this very simple analysis of costs, is that as your sales volume increases and your costs increase, the reality is that your cost per unit actually declines. And that can happen for a number of reasons. Firstly, as I said, you could have efficiency in terms of production in the kitchen, for instance. You may well, as I said, have better buying power. So all of that's driving your cost of sales down. But probably the biggest influence of all is the fact that the higher your volume, your fixed costs are being spread over a broader pair of shoulders or a broader base, and that's driving down the cost, your cost per unit. So I suppose the more volume you get through, then in theory, the more profitable you should be. And that's, understanding that is important really for a whole host of reasons. And again, most of these you'll already be very familiar with. And if we start at the little blue piece of the jigsaw puzzle here, I mean, it's pretty obvious that only when revenue exceeds the total cost will your business generate a profit. Okay, well, I think we all understand that. Understanding the nature of cost does improve pricing decisions, insofar as obviously if you know what it costs you to produce a dish, you should price in such a way that you're getting a rate of return that will cover your fixed costs and allow you to make a profit. So again, that's pretty obvious. Underpricing will damage your business. So if you get that calculation wrong, and we're not here today to talk about pricing, but if you get that pricing decision wrong, it can cause you all sorts of problems. And I remember a famous story from many years ago when Austin released the original Mini, and there's some of us around long enough to remember it. Nobody could understand how they could sell the Mini at the price that it was sold at, and Ford bought one and disassembled it and priced it up, and they realized that actually Austin had got the pricing wrong, and they were selling everyone at a loss. So the more successful the car was, the less well off the organization was, simply because every product was being sold at a loss. So there was a classic example of underpricing. Once your fixed costs are recovered, then really your variable costs are your only additional cost of sale, and at that point your profit per unit increases materially. It's again, that's comes back to making sure that your pricing is right. It comes back to making sure that you understand the nature of your costs. Now, as an industry, we tend to get fixated on a number of sort of traditional key performance indicators, and they're there for a very good reason. But I see this also in the broader tourism industry, where we're fixated on a number of KPIs that we think tell us everything about our business, and the reality is they don't. They should be part of a number of key KPIs that we look at, but they're not necessarily going to tell us everything that we need to do. And maybe a good example of that is that we're very good at looking at cost of sales or gross profit margins. And as we see when we get into the model, I think there's an issue with that we actually need to look at a slightly broader base of KPIs. And what we really need to look at is what's called a contribution margin, which is essentially our sales minus our variable costs, and that gives us a contribution. And if we divide that by the number of dishes sold or the number of takeaway orders, for example, that gives us a contribution per unit towards your fixed costs. And in essence, if that's not positive, you shouldn't be doing it. You should step away from it. And it's not always the case that we look at what we do in those terms. But I'm going to give you a very sort of practical demonstration of that from an example from a fairly standard set of accounts. Now, this is made up, so it's not any business in particular, but hopefully it'll demonstrate how simple changes to the type of information that you look at or provide to your accountant can give you quite a lot of important information back. And the reality is you probably already have this information to hand, but you just may not be using it in this way. So to start off, if we look at a very simple typical profit and loss account, this happens to be called a Big Eats restaurant. I don't quite know where I got that from, but anyway, and you can see fairly standard layout, food sales, beverage sales. The restaurant also not only provides obviously an eat-in service, but also offers takeaway. We have a little bit of private room hire there as well throughout the year, and fairly standard layout, a split of the different types of sales, £1.4 million roughly in turnover. Cost of sales, you can see food cost of sales, bar and wine cost of sales, and there is our little KPI on the right hand side there in terms of our cost of sales ratios. That gives us our gross profit of just under £1 million in this case, which is just shy of 70% of our turnover. We've got our wages cost there, 571,000, and then we've a whole raft of costs or overheads, running down there, which is a fairly typical layout, including depreciation, and if we've got a loan, we've got loan interest in there, and we end up with a profit before tax of roughly £100,000, which is 6.9% of our turnover. And that's a fairly standard layout, so it is that we would see, frankly, for accounts that are generally filed for regulatory reasons. It really doesn't tell us an awful lot about our business. Yes, it tells us what we made. Yes, it tells us what our cost of sales are. Yes, we can work out any of those percentages as a proportion of turnover if we so choose. But we've got two key elements to this restaurant. We've got the sit-in aspect and we've got the takeaway aspect. And I don't know how either of the two are performing. I might have a gut feel, but I don't know for sure how they're performing. So, you know, there are a number of compromises with that layout. So there are. So we don't have that analysis which I've referred to. We've a number of key performance indicators. We have a cost of sales ratio, our payroll cost ratio, which we may use to benchmark against other industry averages, and we have our profit ratio. And there's an old analogy, you know, if you have to measure it, to improve it, you have to measure it. And we can't really do that here to any great extent. So therefore, the management and control of the business is going to be suboptimal in those cases. And just as importantly, if you start making changes in your business, it can be a little bit more difficult to find out what the impact of those decisions are one way or another. So, you know, that's not terribly helpful either. And ultimately, in my opinion, that sort of layout, if that's what you're using, isn't really fit for purpose. And I think some very minor changes can transform that. It's also worth pointing out as well, although you'll be well aware of it, that profit does not equal cash flow. And whilst I'm not advocating that we're going into cash flow today, I just want to make that point very clear that you know, there are a lot of things that aren't on the profit and loss account that you still have to write checks for every year out of your business. So what simple changes can we make to allow us to get much more meaningful feedback from our accounts? Well, firstly, back to the basic principle about analyzing costs. If we split the fixed and variable costs out, not just payroll, but all other variable costs, I think we'll see a transformation. If we add in the number of covers and the number of takeaway orders, that'll generate itself another raft of information that'll be highly useful to us. And as I said, you probably have this information already to hand within your own business. You just may not be using it in a practical sense on your accounts on a regular basis. What it will do when we have this information, it'll help us in terms of forecasting, or you in terms of forecasting and setting sales targets, if that's what you choose to do in your business. And also, I think will give you a little bit of additional confidence in terms of, if you're looking at opening up some new revenue streams to claw back some of your lost capacity, then I think you can, I mean, it's always going to be a bit of informed guesswork at the front end until you get up and running, but at least I think you can go into that with a fair degree more confidence if you have the sort of information that we're going to produce now. So with those basic changes, splitting out your fixed and your variable costs, splitting out your sales by type, whether it's sit-in or takeaway, and adding in the number of covers, exactly the same information then can be used to present the accounts in a completely different way. So now it doesn't change anything here. It certainly doesn't change the bottom line. We still £100,000 profit in this example. But what we can see now is that, for instance, we can now see what our gross profit is per prime area of activity within the restaurant. So here we can see that the restaurant, the sit-in restaurant, has made roughly 859,000 of gross profit and take away 140,000. We then have all these other variable costs split out. So we can see now that we're making a contribution to our fixed costs in our business of 597,000 from the restaurant and just under 100,000 from takeaway, which gives us a total contribution of 694. Our fixed costs are shown here then, 595, and that brings us back down to our profit of 100,000 and our profit ratio of 6.9%. But more importantly now is the analysis that shakes out down here. Now, all I've done in this case is I've just apportioned the food and beverage cost of sales based on the turnover of restaurant and takeaway sales. It'd be great if I had a better analysis, but I don't in this case. But that doesn't stop this being a useful tool. So what we now see down here, for example, is that we can see the average spend. We've got our number of covers and number of takeaway meals there. We now can see our average spend on food and beverage. We can now see our average contribution per cover in the restaurant or per takeaway meal towards the fixed costs of running the business, and what that represents is a proportion of the sales value. Now that contribution is broadly similar across the two, but the point here is that the contribution from a restaurant guest is much higher than it is from a takeaway meal. And all we've done in those accounts is do a split out of our revenue, a split out of our variable costs, and added in the number of covers or the number of takeaway orders. So at least we now know for sure that our takeaway service in this case is actually making a valuable contribution to the fixed cost of the organization. Because if that was negative, then it's adding no value to this. If that was negative, frankly, you either need to find a way of making it positive or you need to stop providing that service. So at least now we have a degree of confidence that's working for us. So those simple changes and looking at it from the point of view of the contribution rather than just cost of sales and gross profit now gives us a degree of confidence that what we're doing here actually starts to cover the fixed cost in the business and helps us generate a profit. So I suppose the no pun intended, the key takeaways from that very simple realignment of your accounts is that with very limited additional information, which you probably have to hand anyway, will materially improve your, I think, understanding of how your business functions and will help you in terms of looking forward, which is critically important at this time. Any service you offer must make a contribution to your fixed costs. If it doesn't and you can't make it, get it to a position where it makes a contribution, get out, because it's back to the analogy about the mini. The more successful you are, the less money you're going to make, and nobody needs that. In this case, the restaurant guests are more profitable at £16.65 per cover as against £10.68 as a contribution to fixed cost. And I suppose what that would do then is suggest to me that if I was going to emphasize and I had the capacity to do so, I would concentrate more on the restaurant guests, but don't ignore, in this instance, you wouldn't ignore takeaway because it still makes a valuable contribution. But if I could only challenge my energies into driving one forward in terms of volume, it would certainly be on the restaurant guests. And you probably know that from gut feel anyway, but here's affirmation of the difference it's going to make. What we can also say here, I think with some degree of confidence, is that a fairly modest increase in the number of covers in the restaurant or takeaway orders is probably going to be even more profitable than £16.65 or £10.68, because within small parameters, you probably won't have any increase in payroll costs. So it's back to every additional sale then is going straight to the bottom line. And I think that's, it's important that we know and understand that. One of the points I made about the initial layout was that it's very difficult to track changes. Well, in this particular case, if we added, for instance, 50 pence to every dish on the restaurant menu, that would now be equivalent to about an additional £15,000 of profit with zero cost. If we also, in that particular example, the variable payroll costs across those two main service areas was 15.7% of turnover. If we cap that, if we managed it on the basis that it couldn't be more than 14%, and there's no reason why you can't do that, or we couldn't do that in this case, that would save another £24,000 a year. So all of a sudden now, for some very small changes to our accounts, we now have the ability to start actually making some very solid decisions that are going to be very positive for the business. So in those two examples, 50 pence a dish really isn't going to mean very much to anybody, and that's just on the restaurant side, not on the takeaway side. And if we could better manage our variable costs overall, in that particular example, there's £39,000 up for grabs for doing making a couple of decisions, costs you nothing to do really, and actually moves your profit ratio from 6.7% to roughly 10% of turnover, and all for a little bit of analysis. So using those basic principles will allow us to calculate the break-even of new services, but we'll come on to that now as we look at the calculator itself. Okay, now I just have to quickly switch over screens here into the calculator, so if you just bear with me for a few moments. Okay, so hopefully now you will see a spreadsheet that has highlighted in yellow restaurant, cafe, bar, cafe and bar standard template, and at the top left hand corner you'll have the Tourism Northern Ireland and the Fáilte Ireland logos. And when you open this document and download it off the Tourism NI website, this is what you'll be confronted with, albeit there will be no information in any of these cells. And really, the pink coloured cells, just as a bit of background, are the ones where you can put information into the cells. You can't put information anywhere else because it's either fixed or it's got a formula attached to it. And really the start, and if you look along the bottom here, you'll see we've a standard calculator, a detailed calculator, which, as I said earlier on, breaks your service down into really 3 time periods during the day: breakfast and morning, lunch and afternoon, and dinner and evening service, which requires a bit more information, but the information required will be very similar to what we're going to see within the standard calculator, just a little bit more of it. And what I want to do is just sort of run through here what happens and give you a view of that. We also have another couple of options, tabs down at the bottom here, and I'll come on to those later on, so I will, and then we have an overall summary, and I'll touch on that when we get to it a little bit later on. So the starting point here would be decide, well, look, what month do I want to do a set of projections for? And there's a little drop down menu here, and this will all be in the accompanying video and indeed the guidance notes that already exist on the Tourism NI website. So you can select here which month you want to do the projections for, and what that does is it automatically updates the days. Now at this stage, we need to enter some core information about your business. And we've 2 ways of doing it. We can either decide that we're going to take a month from last year, i.e. pre-COVID, that was a typical trading month, and we can enter the data in here. And the purpose of doing that, and it doesn't have to be the same month, it could be just as easily be September, but it should be a typical month in your business in terms of average spend and cost of sales ratios. And the reason for doing that is if we don't add new information in here, then it will calculate these key performance indicators and use these as the basis of working out your projections going forward. Alternatively, what you can do is decide that, look, I'm putting my prices up, so I expect my average spend, for instance, when I reopen, to be £32 a head. And this is all net of VAT, of course, rather than £30 a head for food, and 22 for beverage rather than 20, for example. Little cells here you'll see with a little red triangle in the top right hand corner. If you just roll the pointer over that, little notes pop up to tell you this is what you need to do here, or this is the purpose of this calculation. So same down here, you'll see little notes popping up saying, for example, going to put payroll costs in. Remember, you need to add employers' national insurance and pension contributions. And I'm saying here, look, typically that's about 10.4% of gross pay. So just make sure you include that. So in this case, we have an option. We can either put an average spend per cover in, or we can put what we think our absolute revenues are going to be for food and beverage in the first of 4 weeks here. And we can put either or in. If you put both in, it will prioritize the revenues rather than necessarily the average spend per head. Here we have, for example, in this particular case, takeaway. So our average spend and takeaway orders are roughly £12.50 net of VAT, and some drink sales or beverage sales at roughly £2.50. Then down here, we put our weekly fixed payroll costs in, and that should be easily enough for you to calculate. And then what we think our variable payroll costs as a percentage of turnover are going to be. In that previous example, I said, it was just an example, was 15.7. We could make that 14. In this case, I've just got them in as 33%. But if I change that to 14 and you look down towards the bottom of the screen, I'll just scroll down a bit here into this summary. If I change that to 14, you'll see these numbers change down below at the bottom of the screen there. So I'll go back to 33 just to preserve that. Your food cost of sales, your beverage cost of sales, and your takeaway food and beverage cost of soft beverage cost of sales. If you're selling soft beverages, that could be things like coffee, for example. Other operating costs as a percentage of turnover, and other fixed operating costs per week. So I've slotted £1,500 in here. Now, all we now have to do in this standard calculator then, and what happens, sorry, before I get to that, what happens here is this information then gets automatically dragged across to the subsequent weeks. From this point onwards, all you have to enter is the number of covers and any beverage-only sales, in other words, where someone isn't using your premises and consuming food at the same time. And from now on, that's all you have to put into this calculator for this particular month. So in this instance, week 1 of December 20, I wish we were all going to be open in week 1, but that's not going to be the case, obviously. Our expected food sit-in covers every day, there we have 50 each day, other than Friday and Saturday, and you'll see we've got 75 and 95. And we also have a separate bar area where we don't serve food, and that's what we think our take is going to be net of VAT. And with that simple information, these summary results, which are always in this area highlighted in beige, will give us a breakdown of sales by type of offer on a daily basis. So there we have sit-in food, sit-in beverage, based on either our absolute number that we've put in up above or our average spend per cover. There's our £1,200 dropping in there. So there's our total revenue for the day. Here's our food and beverage cost of sales. So the calculation does that automatically. That's our variable payroll costs, our other variable costs, and that's our fixed cost of operating this particular establishment for the week, which is £4,500. Now, what it then goes and does is it then splits that out into sit-in diners and beverage only customers. We didn't put any covers in for takeaway, so this will be 0, but it would analyze that too. So here we now have the revenue for sit-in diners. So of the 35,800, 22,600 was related to sit-in diners. There's a cost of sales. That's our variable payroll costs. That's our other cost of sales. So other variable cost of sales allocated to our sit-in diners. And what this is telling us is that we're making, towards our fixed cost of £4,500 for the week, we've got £6,400 is coming from sit-in diners. Then, as far as our beverage sales are concerned, that's our total, that's our gross profit, our total sales, our gross profit, and that's our contribution to this £4,500. So both those different services that we offer are making a contribution to our fixed costs. So that's good news, and we should forge ahead on that basis. Now, to populate the subsequent weeks, as I said, all of this information gets automatically dragged across. So all we need to do is enter in what we think our trading performance is going to be here. So in this case, in week 2, we're now able to drive some more volume into the business, and let me just scroll back there, and our bar sales are going to increase. So same thing again. Now we're making, in theory, 9,500 this week. Our fixed costs are still 4,500, and once again we have this analysis. So we do in terms of what contribution is the sit-in sit-in diners making to our fixed costs. Well, it's 9,200, so so we're covered, and that's a 28.6% return on our revenue, or profit ratio rather, on our revenue. And our beverage only customers are contributing 4,700 to our fixed cost. And if that was negative, we'd be saying, look, you're not making a contribution to your fixed cost. You really shouldn't open the bar until such times as you're confident that you can get the revenues to a level that allow you to generate a contribution. So again, that gives us confidence that we're doing the right thing. Week 3 and week 4, again, all we have to do here is enter the number of covers that we think. Now, we can make changes here. If, for example, you decided that this week I'm going to put my menu prices up by 50p, So our average spend now, say, overall is going to be, say, for example, £33. That will then fall into subsequent weeks, and it will change the revenue figures down here, and it will also automatically update the cost of sales ratios. So even though it carries the information across, you can change it at any point in time in those cells that are colored pink. So just to preserve the same average spends, we're now getting into our stride here. So we are, and again, it gives us this analysis, and it's the same for week 4. And really, for very little information, once you've populated week 1, it's really a simple tool to use, and it's giving you all of this analysis for putting in really the most basic information that you really need to put into. And at least, I mean, we're trying to guess what's going to happen in the future, but at least in this scenario, it gives a degree of confidence that, look, I'm happy I can hit those numbers. I know what my average spend has been historically, or I'm going to adjust it a little bit, and I think we are going to make money by opening. If there's no contribution to the fixed costs, really, you shouldn't be doing it, because you're just building up a problem every day as you continue to do that. So the 4 weeks are very easily populated there, and then we have a little summary. So we do over on the right hand side, and again, this is all in the video and it's also in the guidance notes. And what this does is it gives us a little summary for the full week. So there's our total revenues for each week, there's our cost of sales, and there's our profit each week for each of the 4 weeks. And if you chose only to look at 2 weeks, for example, rather than put 4 weeks in, what it will do is it will then take the number of days that you've put trading information in for, and that means revenue, and it will then give you an indication of what it thinks you could do for the full month, whether that month is 30 days, 28 days, or 31 days. It will scale it up, so it will. So in that particular case, we populated for 28 days. It's saying, well, look, over the full month, this is the position you could be in. And if you chose to do so, then what you could also put in then is the same information for last year. So in this particular example, our sales were 170,000 last year as opposed to 195. So we're actually up 15% on our turnover, but we're down massively in our profit. Why is that? Well, we can maybe go back and have a look at our cost of sales versus maybe we've put in a higher cost of sales ratio than we did previously, or than we achieved previously. And in this case, then we're making a bit more profit. So we must have controlled our costs here. So again, it's just a little bit of guidance to give you a sort of a sense of whether or not when you reopen the services that you offer, actually you should be carrying them all out, because there is that capacity constraint that you have to deal with, and we all accept that that's a difficulty. And hopefully this mechanism allows you in a very simple way to assess whether or not you think you can actually make a contribution to the fixed cost of your business, and hopefully generate at least some profit going forward until we sort of get out the backside of this. Now, the detailed calculator I'm not going to go into, but it works broadly on the same principle, but asks you for information split across those 3 service periods. That is breakfast and morning service if you offer it, lunch and afternoon service, and dinner and evening service. And you can dictate what those time periods are yourself. It will then ask you for certainly a bit more detail on your payroll. It will ask you to list staff for each of those time periods by rates of pay, and put the number of hours in each day that you think you're going to allocate staff. But again, that's in the accompanying video and the guidance notes. Now, what I also want to have a quick look at here is these option tabs. So in that particular example, for instance, we didn't offer a takeaway service. So what we can do with these option tabs is we can assess, if we plan to do something and we have a number of choices, what we can do here is actually assess whether or not we think we're going to make money at them. And again, if we're not, we shouldn't be doing it. So in this particular example, I'm going to make an assumption that I'm going to offer a takeaway service. And in this particular case, each takeaway order, which is generally for 2 or 3 dishes, the average price net of VAT on the food side is going to be £19 and £7.50 on average per order of beverage sales. My expected food cost of sales a little bit higher here, 35%, and my beverage 32%. And then I have a choice of either entering and it's only incremental costs, in other words, the additional cost of providing the service above and beyond what you're already spending on your restaurant. So I've got two choices here. I can either put additional incremental costs in as a percentage of sales, or where you see a yellow highlighted box with a row number, I can put it in by value. So I've got a choice. So in this case, I've chosen to put the payroll cost in as a value rather than as a percentage of sales, because to be honest, I only need one person to take the orders. The kitchen can deal with the kitchen that's our staff are there can deal with the cooking side of it. And any other variable costs of the service offer. So for example, that might be packaging, for example, that is going to be delivered in. Another cost of opening, I might have to, for instance, let's say, for example, I'm going to use more materials, or I have to provide pads to write on, or whatever it happens to be. And obviously, I would imagine maybe my telephone usage is going to be a bit higher for the sake of argument. So that's another 5%. But again, I can enter these as absolute amounts rather than percentages, and then that could be let's say delivery. Maybe you, as part of your opening promotion, you say you're going to provide delivery costs, so you can tell the model what that is going to be, and then decide that's going to be another 5%. So for example, we can do that. If we're launching a new service, then the chances are there's going to be some level of startup costs. So we need to list those here. And again, we can change these. That little red box tells us a note there. You can edit the wording in each of these cells to suit your own particular circumstances. So I'm saying, well, look, we're going to spend £1,000 on marketing. We've got menus printed up and distributed in the locality. That's been £500. I need certain bits of equipment, and I've had to go and find a staff member. So I'm committed to paying those costs, whether I sell one dish or a million dishes. So I need to recover that, and the model will take account of that. So now, really simple, because all we're doing is estimating here. We're not trying to hit the bullseye. We're just trying to have a reasoned bit of information that allows us to make a decision. So now I've decided I don't provide that service on a Monday. So here's my takeaway covers for food and my takeaway covers for beverages. And here's my incremental payroll costs every day. And here's the cost of delivery. So what this is telling me, in fact, what I'll do is I'll take that out, because it set the rest of the model up with a specific reason in mind, which we'll come to. So yeah, so other costs then. Let me see, where are we here? Yes, so if we scroll down, and what it's telling us is, look, there's our sales per day split between food and beverage. There's our cost of sales. Here's our payroll cost of £1,000 for the week split by day. There's our other variable costs and other costs of opening. And what it's telling me here is that, look, in this particular week number one, it looks like we're going to lose £118. But look, week number one, I wouldn't expect maybe anything else. And it breaks it down by day. So the early days of the week when I don't have that many covers, I'm losing money towards the weekend and making money. And what it does then, it does a little calculation here where there's a projected loss, and says, well, look, roughly, if you could sell another £579, you'll break even. So it gives you an indication of what you need to do in a new service in terms of, look, each week, if I could get another £600 of revenue, I'm probably going to break even this, or I might make a small surplus. That's also good. So week one, we probably would have expected. Let's go to week two then. So week two, we're getting into a little bit of a stride here. So we see some of our covers starting to rise every day. And this week now, it's predicting that we're going to make a small surplus of £413. So this has to be zero, because we're now making money this week. But what the model then goes and does, because you're making a profit, is it says, but don't forget, I've got my pre-opening costs or my setup costs to recover. So what it's telling us here is, on the basis of that performance, we'll recover all of those setup costs in roughly just under 6 weeks. So we can perform at this level. Once we get beyond another 6 weeks, pardon me, we'll be in the clear profit, and that will be good for the business. So we're into week 3 now, and again, all we're entering is the number of covers sold and any other costs that we choose not to enter as a percentage. And in this case now, where our covers are starting to ramp up as the availability of the service becomes more familiar. And here we are, we don't need any additional sales to break even. And now it's telling us, look, at this rate, in less than 2 weeks, you've recovered all your fixed costs. So it really is that simple in terms of, now obviously if that was negative after week 3 or 4, you might make the decision, look, this is really not going anywhere by the looks of it, and I maybe shouldn't be doing this. So very simple calculator that helps you hopefully make informed decisions. And similarly, there's a little summary at the far end that says, well, look, you put information in here for 24 days because we're only open 6 days a week. And if you were looking at this full month, then this is what we expect to see as a profit in this particular case. So as far as the calculator concerned is, I know it may look daunting in terms of a page is full of numbers, but the reality is, and I hope I've demonstrated that to you adequately, it really is quite simple to use and requires absolutely the minimum amount of information that we can possibly get away with to allow the formulas to actually function. And that you will find this a really useful tool in terms of looking at your businesses going forward once you can reopen again. So look, at this point, I need to go back to the slides because I have a number of other topics that I need to talk about. So we need to go away from these from the spreadsheet. So again, just bear with me a second or two, please. Okay, so having had a look at that calculator, I hope that wasn't too daunting. This calculator can be found in the Tourism NI COVID-19 Support Centre. So it's available to download, and you simply pull it down onto your own PC or your laptop and rename it and save it there with a name that means something to you, and then you can go ahead and you can use that whenever you need to, and hopefully that'll be a very useful resource for you. In terms of, look, there's a lot of other supports as well available from Tourism NI, and whilst in essence, they're being updated virtually day and daily. And of course, we'll all be aware that earlier on this week, the executive made another announcement about supports, obviously during this current the incoming lockdown period. That because that's being updated every day, there's no point me flashing them up on the screen. But you will find all the government support information on this link again in the Tourism NI COVID-19 Support Centre. So please, look at that on a regular basis because it is being updated, and indeed the announcements from earlier this week, we don't have the fine detail yet, so it most certainly will be updated in the near future because ultimately, whatever benefits are there for you, you want to make sure you're getting them. There's also a financial modelling template, which is more to do with your cash flows. That is also available from the support centre, so that's also available by following that link. And last but by no means least, Tourism NI have just recently put together or opened up an inquiry helpline, and that's a telephone number for it. So again, if you want to speak to someone rather than necessarily download all the time, there's help at the end of that telephone number, and they'll be able to steer you in the right direction. Moving on then, because we're still a wee bit to get through, just some hints and tips in terms of working with your accountant. If you don't have, particularly if you don't have an in-house accountant and you're reliant on getting your information from your accountant who then filed your accounts and does your tax return and so on and so forth, then I think it's worthwhile, if you're not already doing so, having a conversation with them about how you can get better information about your business. So these are really some conversation points. Some may be relevant to you, none may be relevant to you, they all may be relevant to you, but you can decide. We looked earlier on at an example where some very basic changes to your accounts can be so much more meaningful to you in terms of assessing how your business is performing and perhaps allowing you to focus on some of those areas that you need to make changes for the betterment of your business. So if you're getting that standard set of accounts that we looked at, which really don't tell us our profit, but don't really tell us a great deal more about the different service lines that we offer, then have a conversation with your accountant about how you can split out your variable and your fixed costs across your service lines and come up with a presentation format similar to the revised one that we looked at a few minutes ago. If you're only getting accounts once a year or once a quarter, I would strongly recommend that if ever there was a time that you needed more timely information, this is it. And so if you're getting your accounts annually, then I suggest you get them at least quarterly. And if you get them quarterly, maybe you need to look at getting them monthly, or if you're getting them annually, maybe you need to look at getting them monthly as well. But with that will come a cost, obviously, and I think if you need your information on a more regular basis, then again, that's another conversation you need to have with your accountant in terms of, I would like this on this time frame or this frequency. When can I get it, and how much more is it going to cost? Because the reality is, if you've got problems in your business, and you may know in your heart of hearts you have, but you can't easily quantify it financially, and you're getting accounts once a year, you've lost at least 6 months to address some of those problems. And really, that's not a good place to be if you can possibly avoid it. One of the things that we looked at in that revised set of accounts was adding in the number of covers and the number of takeaway orders in that particular example. So inevitably, if you want more information from your accountant, you're probably going to have to provide them with more. So how do you do that? Agree that with them and agree when you're going to do it. And it may well be, for instance, that you already have that information in your electronic point of sale system, and most of you likely have one. It's probably in there, you just may not be pulling it out on a regular basis, and therefore it would be a good idea to provide that information to your accountant. If you're trading at a loss, or you think you're going to trade at a loss, then clearly you need to sit down and have a serious conversation with yourself and your team, and probably with your accountant, about how you need to improve the situation. What additional revenue do you need to get yourself to a position where you at least cover all of your fixed costs and ideally start to make a profit? And the model can help you, as we've demonstrated. But look, you need to be that wider conversation, I think, with your accountant as well, because they'll be much closer to your business than I can be. I'm trying to talk in generalities here, and therefore there'll be specifics unique to your business that need to be taken account of. Also, what are the impacts of financial support that you've already received? So, for example, you may not have paid your VAT yet. You may have a deferment on your loan, or you've got a CBILS loan, but at some point they have to be paid. And as we said earlier on, profit does not equal cash flow. So again, that conversation needs to take place with your accountant about, how much do I need to be making to make sure I have enough money in the bank to discharge those liabilities when they fall due, because they will fall due, and you need to be ready for it. Some other topics, look, new service ideas. Again, you might have that conversation with your accountant, but the model will allow you to actually assess whether or not that's a good thing to do. So you can use the models quite simply. But again, worth a chat with your accountant anyway. Are there any cost reduction opportunities? Quite apart from a variable, fixed costs are only fixed until they're not. I know that's sort of stating the obvious, but for instance, if you're renting your premises, and of course here rent tends to be fixed, can you convert that, with the help of your accountant, to a revenue or turnover based rent? That's clearly becoming much more popular, largely driven by the retail sector. But I think if there's an opportunity to do that which works for you, then that's maybe something you need to consider. And again, it's another conversation point, I think, with your accountant, or indeed your fixed staffing costs. If you don't believe you're going to have the level of turnover to justify it, then unfortunately, if you haven't already done so, there may have to be some very hard decisions made there. But again, you have to talk those through, I think, with your accountant. The impact of moderate increases on your income. Don't overlook that fact. We certainly have a number of clients, and one in particular, who don't adjust their prices once a year. They make small incremental changes every 2 to 3 months. Even during this year when they've been open, they meet zero resistance from their clients, but it means that they're continually moving their margins just that little bit. And if you've lost that opportunity to make a price change, and I think in the current climate, people almost expect it, because they know that the actually providing service has gone up. Okay, there's been a VAT reduction, but the reality is, lower volumes in your units, probably an increase in your cost of sales as well in terms of product coming in. I think every time I go into the supermarket, it seems to cost me a little bit more than I did the last time I went in. So I think there's that expectation. So don't ignore that opportunity. And finally, and by no means least, are the government supports being maximised? As I said, keep an eye on the Tourism NI support website, because those are changing day and daily. And the local executive and the government are doing as much as they can do at the moment. I know we always think they could do more, and I'm sure they could, but the reality is at least there are a number of supports there, and they are changing and updating on a regular basis. They're there to try and help. Okay, they might not take the full sting out of the tail, but they're there. For goodness sake, please make sure you're getting your fair share. Now, at this point, I just want to hand over